there's been absolute scenes coming across markets in the last 5 days. It really has been an absolute lesson in understanding what can happen when everyone jumps ships and gets out of these very concentrated and very crowded trades at once. There's been a lot of forced selling coming through. Liquidity's been an issue. And again, these factors have exacerbated some of the moves that we've been seeing on the dance floor. Now, the question is have markets become too pessimistic and priced in too dark a scenario that could be walked back going forward? Of course, the market has a lot of questions at the moment and desperately wants answers. We're going to explore all of those factors today in the trade-off. Hi, Chris Weston, Head of Research here at Pepperstone. I'm going to be joined in 2 seconds by Blake Morrow from Forex Analytics. And it's been a turbulent last 5 days. The market had gone in and expecting a fairly dark scenario. You could say this was at one stage pricing a growth shock. I'd probably say this is probably more of a growth scare now in markets. But have things become too pessimistic and we've seen some extreme volatility, which of course has significant implications for the way that we trade the markets. Mr. Blake Morrow, the volatility whisperer, you did bring the vol. I think we called it a couple of weeks and it's just been working very nicely since that point. For me, these are day traders markets now. I mean, I think if you're a long-term investor, you really want to sort of keep yourself out of the news flow, keep yourself unemotional around what we've been seeing. Because I think longer term, there's going to be some of these great companies, your Nvidias, your Microsofts. I think they're going on sale at the moment. You know, anything with good pricing power. I think, you know, the market. If you're not in the stock already, you know, if you kind of almost be hoping that this continues so that you can get some of these great businesses at better prices. But I think right now, in terms of for the trading community, which of course we are, and what we represent, you know, the extent of the movement that we've been seeing, the pronounced range expansion, the sheer moves that we've been seeing. I mean, I'll ask you right now. I mean, these are the ones you just got to be in front of the screens. It's very, very difficult to carry risk overnight. You've got to be squaring those positions as you go home. You've got to be reacting to 2-3% intraday moves in various markets. It's a day trader's market, right?
It is. And it's, and I bet you over the weekend, you didn't have Nikkei down 12% on your bingo card, did you? You didn't.
We've got a lot of bingo cards around the house, but no, Japanese banks down 15%, trading like a penny stock, despite being a collection of individual names. You know, no one expected that, but then no, we didn't expect a 12% rally the next day, and you know, I think that's just where we are. But I mean, I think you've just got so much liquidity coming out of the market. You know, a lot of forced selling, a lot of margin leverage positions which have been unwound. You know, and I think that's the issue. We just created a vacuum. The buyers stepped aside. No one was buying the market. Loads of people selling, and it just creates this big move down, a concertina effect, and that's what you get, right? But the question is has a lot of that positioning been flushed out, and we're now in this great reset?
Well, I think we should probably jump into the market pulse so we can dig into it. What do you say, Chris?
Let's go. Do it. We're sort of running the risk of jumping the bag out of the cat, really, then, won't we? But let's go into the market move. So yeah, it's been just a saturated, concentrated position. Everyone's been talking about the idea that carry. There was a significant amount of money in global carry positions, yen-funded carry positions into, you know, obviously into the high-yielding Mexican peso, some of the LATAM currencies, into emerging market debts, and of course, you know, people were borrowing very, very cheap money at the time, and financing capital positions in Nvidia and the tech plays, semiconductors, and of course the Bank of Japan raising rates 15 basis points, promising more, and then obviously the volatility that's come in, other factors. Yeah, I think the other factor is that, you know, on Friday after the payrolls number, you know, people started talking SARM rules, recession bets got put on, and it just caused the straw to break the camel's back, so to speak. So, and it all just sort of slowly, then bang, all at once. It just came into a liquidity and capitulation move on the Monday open. Japanese banks really taking the brunt of that. So, for me, this is about positioning more than anything else in all of those markets, all coming unwind, massive flow, forced selling, all coming through at once. Positioning, to me, Blake, is something that you've got to be cognizant, plays into risk reward, and you know that when it happens, you can get these extremely powerful moves, but you wouldn't necessarily go short on it just in that principle alone. How much do you read into this? Is this just purely about positioning, or is there more sinister factors at work?
Well, first of all, great question, and I agree with you wholeheartedly. I believe it was 100% positioning that forced unwind, as you put it. I think you eloquently put it. There's no need for me to rehash it. The question that you are asking and presenting to me is this a good place, or is this a good time? Do you think it's over? And the answer to that question is, I don't think so. And the reason why I say that is because we've been in such a large expansion for so long. I think this is the beginning of a turn that we're seeing in the market. And the funny thing is, I shouldn't say funny. Funny is not the right word to describe it. The interesting thing is I've been talked to, or I've been called and approached by so many people that I normally don't hear from, that are really paring back what they're even putting into the markets moving forward in their retirement accounts. And that to me is really interesting, because that is the flow, that is the invisible hand beneath the market. And it's very anecdotal and it's a very small sample size. But when you get multiple calls like that, I know it's on the mind of so many people. So do I think this is the time that you need to be stepping in front of it? No. And I do think that this yen trade could continue even further. And I know the Bank of Japan was out there, trying to smooth things over. But you look at the price action even tonight, as this morning as we're filming, the yen is strengthening and coming back alive once again. So I think you have to be defensive.
Just at risk of we're going to the third point, data to drive. Then for me, we can go into the rate setting, but for me right now, we've had a lot of that flushing out position. I'm sure there's way more to go, but we're sort of just consolidating at the moment after a massive move. And I feel like the market now is saying to itself, look, we've gone a little way into quite a few people have subscribed to the recession trade, probably walked it back a little bit, because it's still too early to say that everything's doomed. But for me now in the data, the market's got a lot of questions, and those questions are we really going to see a recession? If not, are we in at the moment in the US? And the data has to drive that point. We're going to have to look at next week. We've got jobless claims tonight. They could be interesting. CPI next week. We've got retail sales next week. I think they're really important numbers. But these growth data points, these labour market data points, are what the market's seeking out. If they're weaker, if they deteriorate, then the market will go after central banks and say, look, we are clearly going towards a recession. They'll start ramping up their recessionary bets. You see that in the 2s10s curve. People are buying up downside puts on IWM, the small caps. There's a whole heap of different recessionary trades that people have hedged. I wouldn't be doing them now because they're expensive. But people are looking at them. So if the data comes in, the market goes after the Federal Reserve and says, what have you got? Where's the Fed put? Where's the strike on that? And then we see tightening of financial conditions. But if the data comes in better, some of those recessionary fears will be walked back and equities will rally, and we'll see the yen under pressure. But it's the data which is going to drive. And then the question I'm going to ask you then, I'm going back to 50 basis points. If the data does deteriorate, with the market almost pricing in 50 basis points of cuts for September, will the Fed deliver that?
And that is a great question. And I would say, hell no. And it's not only are we in an election where you look at the political climate here, and obviously a lot's changed just in this week since the last time we spoke, but you've seen the political environments just continue to heat up, and the Fed does not want to put themselves in that situation. So will we even get two cuts or a 50 basis point? I think, first of all, I think the cries for it are just ridiculously silly right now. But more importantly is they're not going to deliver that in September, even if they feel that the economic data has weakened so much over the next 30 days. The most they will deliver is a quarter.
Let me ask you a question while I got you.
So, yeah.
If they deliver, obviously we've got 5-6 weeks until the Fed meeting.
Sure.
And, the market's pricing in 2 rate cuts, 50 basis points. But if the data does improve, obviously the market's then going to pare it back to 25 basis points, and they can deliver 25 basis points with ease. But if the Fed meeting was right here, right now, and the Fed delivered 25 basis points when the market's pricing in 50, instinctively you'd say that the market would de-risk, and they've underwhelmed the market pricing. The dollar's going to rally, and risk would come off. Conversely, could you have an out there way of thinking and say, if they were to deliver 25 when the market's pricing 50, could equities rally on the back of that, in the sense that the Fed are less concerned, that they're saying, you guys, you've got it under control. Our models are saying, yeah, fine, we're in the late stage economics, but things aren't that bad. You're priced in too much, and we get a risk because the Fed are saying that they're seeing things in a better light. Could that be the case?
I don't think so.
Yeah.
And the only reason why I say it is because of the election year that we're in. If this was 2023 or it was 2025, we were dealing with the same issue and it was an election year, then I would say yes. But I think that the market really has keen awareness that the Fed is going to avoid a rate cut as much as they can. If we get 5 weeks from now and data is not so bad, but the market's still expecting a quarter, I don't even think they deliver it.
No, they'll cut, man. They'll cut. They have to, in my opinion. But you're right. I mean, things could look very different in 5 weeks' time. We'll see. Sure. I do not subscribe. Hit me. I do not subscribe to the idea that the Fed is political. I don't think they're going to be overly concerned by that. If the data's there to justify a cut, if it's cooling down, the labour market, the unemployment rate's 4.2% or whatever, they'll cut rates by 25 basis points. They need to. I think they need to bring it round to a more neutral setting. But we're not going to see emergency cuts, which some people... There's no way in the world we're going to get an intermeeting cut. That's ridiculous. But, life could be very different in 5 weeks' time. But, I think before that point... Powell's going to be speaking at Jackson Hole, in a pretty close period of time, and I think that's going to be a very interesting speech indeed, and that could set the stage for September.
So just before we move on to sentiment, and we just need to talk about for 1 minute, I have to say that they are not political. I don't believe they are political. They don't want to be viewed as political, which will make them political.
I think viewed is the right way. Yeah,
that makes sense. Anyway, hey, real quick. I just wanted to mention sentiment before we go, and because sentiment, as you can see, has turned south really fast. Everybody's talking recession. Everybody's talking rate cuts. Everybody's looking at now. They're singling out Intel. And do you see Intel's below 20? By the way, I mean, go look at Intel stock. A chip manufacturer, Intel.
Disgusting trade.
You will be surprised when you look at that chart. Anyway, sentiment has turned south really fast. And the scary thing that the Fed has to grapple with, it's kind of like inflation. Inflation and sentiment actually go hand in hand. It's like that genie you don't want to let out of the bottle, because when it turns south, and they can't afford it, because when you're a business leader and you own a small business and you have, globally, you have 300, 500 employees, 100 employees, 50 employees, whatever it is, and you start thinking, man, we're going into a recession. I'm getting fearful. I don't want to hire. I'm not buying. This sentiment is something that is scary, and I think that needs to be really walked carefully, a fine line carefully with the Fed and everybody else. What are your thoughts about sentiment and how fast it turned and how quick it turned?
Well, I think it's better. I mean, on Monday it was properly dark. Bunkers, canned food, handguns, that kind of thing. But I think calmer heads are prevailing. I still think sentiment's pretty bad, pretty shot to pieces. I mean, if you want to go and hedge downside portfolio protection, it's still very, very expensive. The VIX curve is clearly backwardated. It's in a pretty bad space, and I think sentiment's still pretty bad. But I think we've just got to watch the data now. If the data deteriorates from here, then things could get a lot darker, and the market will go after a response from the Fed, and then they'll tighten financial conditions. If the data comes in better, then I think sentiment, that negative sentiment, we climb the wall of worry. If equities rally, yen comes off. It's as easy as that. So we're in a bit of a holding pattern now until that data starts rolling. It's not going to happen overnight, and we get the clarity. So the missing piece of the jigsaw is the data, the key growth data points. Have we priced in too much of a dark scenario? I think sentiment's pretty bad, but it could get worse. But it could get a lot better if the data comes in and shows us that we priced this wrong. I think that's the way to look at it.
All right.
Let's go to That's the Setup. All right, I'm going to go to the old Nikkei.
Woo! Oh, this is going to be a good one.
All right, yeah, obviously it's, what we just seen, I think one of the charts we looked at last couple of days is the level of margin transactions that are taking place in Japan. Highest level since 2006. There's just been a lot of money that's been borrowed by retail investors in Japan, like massive levels, to go into the equity market. International investors have been piling into Japanese equities, one because it's priced in yen, but also the market's been on a tear and it's done very nicely. So I think a lot of the factors that we've taken place have just come and wound. I mean, it's not just been an overnight affair. It's been taking place for most of July. But then that moved down, bang. And it's just full selling. It's poor liquidity. Top of book liquidity was gone. No one was buying the market, and it just went bang. Now, what we're saying technically, why I've got this is we've tried to make a move higher. We got into the 5-day exponential. We filled the gap from the Monday's open, and the sellers have just hit that one back down every time. So we tried yesterday to make a strong rally and sustain the rally with momentum. I'm not impressed by what I've seen there. I wanted to buy it, and this idea about buying, not buying the dip, but buying the rip after the dip, it was playing out, and then we're like, if this can close, I think this has got legs to really kick up. But it's got smacked back down. There's supply. It's similar to what we've been seeing in S&P futures, Nasdaq futures. So we had our chance to make a really strong rally. The sellers have smacked it back down. Until we get that close above those levels, then it's difficult to really chase this one. We could really chop around, so it could go either way. But this is a really interesting chart for me. I've got to be watching this one closely because we tried yesterday to rally. The sellers said, nope, not having it. If this rolls over from here, it could get pretty dark again. So you've got to have this one on the radar.
Yeah, absolutely. And I'm glad you brought that one up. And I'm going to be having something similar to say when we get to the S&P. So make sure you stick around. But first, let's talk about volatility. And this is where, Chris, the story starts. And this is where everybody should be looking at. Now, this is the Pepperstone VIX, and I want to let Chris talk about it here in just a second because it's different from volatility that some of you trade and some of us in North America we queue off of the S&P VIX. But I want to show, because it's a very similar chart, that green line right there is basically showing you the breakout in volatility, and you should have that as a baseline of if we are trading above that green line, the market is nervous. That means everything that you should be doing is defensive. We get below that green line and we start breaking below some of those previous resistance levels. That's when volatility is easing, and that's when it's going to be a little bit. It'll be a little bit easier taking risk on type of trades. So you should have some sort of barometer that you keep on your screen, and I think VIX, especially the Pepperstone CFD, is a good vehicle to do that. Chris, tell us a little bit about the VIX that you guys track.
Well, this is priced off the futures. This is the futures price. A lot of the markets we do, we'll take the futures price and we'll make a cash market, which is the equivalent of the underlying cash market, but which you can't trade because it is just a cash market. But this is our equivalent of the futures price, effectively, a front month futures price. So what happened on Monday was that we saw the cash VIX trading up to 65%, but no one could trade it because it was an anomaly. It was a pricing issue that took place. The actual underlying futures market got to about 36%, which is extreme, but it's pulled back since that time. So people quoting the VIX trade up to 65%, which is that's sort of thematic of what we saw in 2020 when the calls of shutting the market and all this kind of stuff. It never got there. No one could trade that price or that level. So when it came back down to where we're trading at 27% now in the cash VIX, that's sort of the equivalent. If you can equate that out, that equates to moves in the S&P over the coming 30 days, daily moves of 1.8%. So you still got that nice amount of volatility playing through there. So it's a good one. I definitely you can trade this with us and you can go long and short and trade your view on volatility. I think that's an interesting one. Let's go to gold.
That's the benefits of being a Pepperstone trader.
Well, I mean, there's a million ways you can trade the VIX, but this is just one way that we offer. But thanks for bringing that up. The gold. Let's go to gold because this is an interesting one because I would have said, Blake, you give me recession fears, you put on recession trades, you see real rates collapsing, and you've got yourself a situation where gold trades 2,500. You add in geopolitical issues, and those headlines are clearly underpinning what we're seeing. But what we saw is that gold got caught up in the whole liquidation malaise. So everyone just chucking everything out, buying into bonds, and gold got carted out. The question is now a lot of this position, this full selling has probably taken place to an extent. I'm sure there could be more, but we're not seeing it at the moment. But with moves that we're seeing in the front end of the Treasury curve, the geopolitical issues still here, it's interesting that we're not getting that upside now. The 50-day is capping the losses. The upside's not really finding it. And maybe that's people saying, you know what, if I want to hedge my risk at the moment, if I really want a proper hedge out there, given that there's IWM puts are really expensive, and cyclicals have been underperforming defensive. All these kind of areas that you might look at. Volatility is high, and options premiums are high. Maybe the best other place to be is actually the Japanese yen. If we think that shit's going to get real, then the Japanese yen's probably the best place to be, and we're not seeing that in gold. It's not really acting as that safe haven. So it's interesting. It's been caught up in sort of 2480, downside sort of 2350 odd, and it's found a really nice range. You've got that sort of double top neckline and 50-day moving average. I think if it breaks, then you've got some decent downside in gold, technically speaking. But I would have argued that the dynamics we've seen should be very, very good for gold. It's just not happening at the moment. It says to me, if you want to hedge yourself against deterioration in US data, then probably the yen's the best place to be, not gold at this point.
Very good. That is a very good point, Chris. And maybe it's a little bit of a positioning problem too. If you don't know my Costco retailer just down the street, I can pick up gold bars right there. Me and everybody else at Joe Public. So something to think about. All right, let's go to my last setup, which is the S&P. And Chris, this one's really important for me because we closed at the lows today, and this is a 4-hour chart. Now, typically I'll bring a daily chart.
Big reversal intraday, right?
Yeah, big reversal. It's a pennant or a flag pattern. Any which way you look at it, it's a continuation pattern. The problem with this pattern is if we do complete, it takes us to fresh lows. That means it's going to take us below what you guys see there as support at the 49.30 level. That was the low from back in April. We should break that. And if we do, then you have to think about what that does to the structure of the market. I've been arguing with our community, Chris, for the last couple of weeks. We're really probably starting a near-term bear market. Ooh. And this is going to be a market where we're going to be selling rallies for a while. And I know. And you know what? Michael Brown's not going to be happy I just said that. But when the trend changes and you start making lower highs and lower lows, if we do crack 49.30 or whatever the low is there back in April, I would argue that we are going to be developing a trend change.
Yeah, right. Well, I think at the end of the day, right, there's two dynamics I want to look at. The market is saying that rates are too high. How do I know that? Well, the real Fed funds rate, the effective rate, if we adjust it for inflation expectations, is trading at 2.93%. It's too high. It's the highest level I think it's been ever. Certainly at least since the year 2000, the five-year swaps have been provided. So, you've got real effective rates at nearly 3%. You've got the 2-year Treasury trading 137 basis points below where the Fed funds rate is at the moment. Now, that tells me that the market's saying that Fed policy is way too tight. It needs to come down. Until that sort of the Fed come to the party, I think if the data does deteriorate, and it's a big if, it could easily get better. But the question we've got then is, where is the Fed puts price? The market will go over where that strike is. One of the reasons why we've been so bullish on the market for so long, and why people have been pushing markets higher and selling volatility above the market, which is another big issue, is because the Fed put is in the market. People have said, why sell equity when we've got this insurance with the Fed put? If we see that dynamic playing out, the market will say, where is that strike price? They'll go after the Fed and they'll tighten financial conditions. And that's where a bear market would develop, in my opinion. But the data is going to drive that. Let's go to play of the day. I'm going to go for Tesla. Short Tesla. Yours. Short it. Now, why do I like this one short? I mean, obviously, this could easily rip higher. It could do. Obviously, no one knows, apart from Nancy Pelosi. But I mean, I think if you look at this right now, we've got that nice horizontal resistance. That's the gap, which hasn't completely been filled from Friday's close. And we've tried to go up there, but failed. We've had a bearish day today. It's down 4-5%. I like this one short at the moment, and I feel like this could kick. If we can get through Monday's lows, where do we get to? I think we got down to about 182. If we can break through those, I'll be adding to shorts. But I think closing above sort of 210, stops on above 210 would give me where I want. Why do I like this short? I mean, on price actions, you're shorting into a bear market or a market that's already in free fall. We get out above the gap, so you close that. You've got some risk in there. you've got Elon Musk, who's becoming incredibly political. He is so emphatically sided with Donald Trump now. If we were to see Harris pull ahead, obviously this could be one of the single biggest Harris trades out there. We'll talk about Trump trade. I think short Tesla would be a Harris trade further down the line. You've already seen Rosman in Europe pulling its sponsorship from Tesla, or its involvement from Tesla. One of the big buyers of EVs there is pulled out because of his involvement. And I think if we were to see shit get real in markets, and if we were to see what you just talked about there with the S&P, which is a big if, I don't know if that's going to happen, but if we were, I think Tesla's going to get smacked down to those lows. So I like being aligned with the trend. I think the story is hard to be long this play unless we were to see a significant improvement in market sentiment, in which case I've got a stop loss just above and above that 50-day moving average, just to protect me if I'm wrong. And I want to add on, start off in a small position and add, through those recent lows of 182, and then look to build on that.
All right. Well, Chris, you said the magic words, know where you're wrong. And that's where I'm going to talk to you about the Aussie yen. That's going to be my play of the day, which I've got a lot to say about this. But if you remember last week and the week before last, Westy kept saying sell rips. Kiwi yen, I think, was one of your trades, right, Chris? Another one was another yen pair. Sell rips. Well, we got that rip in the Aussie yen, and I'm selling into it. So must hate while below 98 is what I'm going to say.
What a poet. Wordsworth.
So the 38% retracement comes in around 97.50. We broke a trend line that has been established since 2020. And so while it's below that 38% retracement, basically 97.50, I'm going to be a seller. And I'm looking, and unfortunately it's dropped 60 pips since we've been filming this show. That's how fast things are moving right now. But that doesn't mean I don't want to be on the short side. I do not have a position, but I know where I'm wrong. And that's the most important thing with any of us traders, is knowing exactly where you're wrong. So while we're below 98, I must hate it. That's it, Chris.
Very nice.
I'm going to get on the short side.
Well, thanks everyone at home for watching. Click the like button, subscribe if you did find yourself liking the show. And Blake, thank you very much for your thoughts. Look, but just before we go, just stay safe out there in the markets. These are big volatility markets at the moment. We are seeing big ranges. You need to know how to adapt. That typically means, you probably want to be in front of the screen, want to be dynamic. If you are holding positions overnight, you probably need to trade with a wider stop loss. And therefore, if you're going to take on that additional risk, you need to take your position size down to accompany that. Obviously, if you're trading with tight stops in these big volatility markets, the propensity to just be stopped out is obviously high. So just understand how to adapt to movement, to the volatility, to the ranges. Typically, I think the best place is to make sure that your position size is dynamic to that volatility. But do get in touch with Blake or myself. Leave a comment below in the comments field about how you're sort of looking to capitalise or look to protect yourself in these highly volatile markets. And we'll see you back next week for more of the trade-off.